we're going to be taking for our theme today a problem that I think we've all come across, and that is getting in and out of our positions at the right times. We got this theme. I used to teach a local IBD group. I was a host at an IBD group, Investors Business Daily. Had one of the group members, he approached me at the end where we were just kind of, chatting up, and he said, I've got the best idea for a trade recommendation service. And, we said, oh, no, not again, not another trade recommendation service. He said, no, it's a really good idea. You got to hear me out. I said, all right, what is it? He said, here's how it would go. I'll send out what I'm doing, and everybody that is subscribed to this recommendation service, all they've got to do is do the exact opposite, and they're going to crush it. And so we had a good laugh about that, but it spurred a serious conversation and a real problem that a lot of us face. How many of you guys can connect with that feeling where it feels like the moment you get involved in something or even get out of something, things tend to just go exactly against you? How many of you guys can kind of relate to that? Say aye. Find that chat and say aye. EG says, happened to me so many times. Me for sure. From Trader. This is a big problem. Mark, yes. Capital letters. We all have kind of a love-hate relationship, but we're committed, and we're too deep into this that we can't give up, right? So yeah, Scott says, I've had my issues Intel at 72, then down to 12. So yeah, it's definitely a big problem. And so that's what we're going to be discussing here today is what I believe is your best path forward to fixing this issue. It's not another indicator. It's not another tool. It really is understanding what drives the market. And I think that if you can really understand the forces that drive the market and learn how to follow those forces, things really start to change radically for you. I always like to start this way because I never know who is attending in their living room or their office and what they're going through. But I like to start this way because I know a lot of people have been at this for some time, and you have some success, and then you hit your head up against the wall and give it all back. And it's just like this endless cycle of consistent inconsistency. And the reason why I like to start this way is because no matter what you've been through, I think that by understanding the forces that move the market and operating in line with them, things can change for you very, very quickly. So for those of you that have not read his book, Ray Dalio, he's the founder of Bridgewater Associates, which is the largest, most profitable hedge fund in the entire world. How does this relate to you? It relates to you in a lot of ways. In particular, it's hard to relate to these big institutions, but Ray Dalio, after he started his hedge fund, he ended up having some high net worth contacts that trusted him and gave him a shot. And he fell flat on his face. 8 years after he started his management firm, he'd lost tens of millions of dollars, went totally broke. And I love what he said about this experience. And nowadays, it may be a little bit difficult to relate to an organization like theirs, that they've got now $160 billion of assets under management. I mean, just the sheer size of that, a tenth of 1% is still, they've got 160 million. But early on, it wasn't that way. It really was a headache. And I would encourage you, if you've not done so, pick up Ray's book, Principles, Life and Work. Principles, Life and Work. This is a book that you should study if you are engaged in the markets. The story that Bridgewater Associates has been through is really your story. You may not manage hundreds of billions of dollars, you may not consult world governments, but you may have lost a lot of money. You may find that you are treading water. And there's a lot to learn from a firm that did that, blew everything up, and came back to be the most dominant force in our entire financial markets. Maybe the only greater force is our own Fed. He says this, he says, my experience over that period was like a series of blows to the head with a baseball bat. Being so wrong, and especially so publicly wrong, was incredibly humbling and cost me just about everything I had built at Bridgewater. So today, what I'd like to get into with you are some real solutions to this problem. And that solution is by following the big institutions that move this market. And that's really my thesis. And I think that if you do that, things really radically improve. I got this email from an individual that we've contracted with to kind of do this more rapidly and follow the forces that move the market so he can have consistency. He sent me this email, and it took him about 18 months. He didn't start with millions of dollars. And he had been doing this for a long time and had bounced around from a lot of different, ideas and practices. But he sent me this. He says, now my biggest problem is I'm growing this account so quickly, I got to pay more tax if I want to convert this into a Roth. Now that I'm all in with this investing technique, I'm currently generating an average of $50,000 per month among all my accounts. And look, I've been where you're at, and I get that there's a lot of junk out there. But what I'd like to do today is, I'd like to get real with you. This is my real money account. These are positions that I've put on today using the exact methodology that I'm going to show you. What you're going to find as we talk through this today is that there is zero risk in any one of these positions. I have no risk whatsoever. I'm guaranteed to make something no matter what happens, whether the market goes up or down. And I'm able to do this because there is a very predictable format of knowing when to get in and when to get out of things. I'll go through this and these positions here as we get into this, but this is something that really works. This is not an extremely large portfolio. This is a portfolio that does not have millions of dollars in it. And I'll even show you. I mean, here is that right here. It is about $100,000 account. And there's a lot that you can do with an account like this to generate revenue and income if you have a way to consistently get in and out of positions at the right time. And so that's what we're here to talk about here today, is what we call is following the smart money. How many of you guys have ever heard of that term, following the smart money? You've ever heard of that term? And what is the smart money? The smart money are those that just seem to just always be the ones that win. All right. Let me just pull up a slide deck here from JP Morgan Chase, right? You see these little images down here. They're the Bridgewaters, they're the Goldman Sachses, they're the BlackRocks, the JP Morgans. They're the individuals or the institutions that are managing hundreds of millions and billions of dollars, and their activity is what actually moves the market. Take a look at this. These guys are winning on such a high level. Look at their slide deck from their investor day. This is JP Morgan Chase. You come down here and take a look at their trading business, okay? So they reported 5 years of returns from their trading activity, their stock market related businesses. And remember, there's about 292-ish trading days in any given year. Notice they only have 2 years in 5 total where they reported any losses, net losses by the end of the day. They had 7 losing days in 2012 and 2 losing days in 2015. And then they have no losing years in 3 years out of 5. Look at their average daily revenue. Their revenue from year to year, even though they had some losses in 2012, right? Next year, their average daily revenue, this is in millions of dollars, it's $72 million per day on average. Overall, their average daily revenue is not like way up and way down. This is predictable, it's consistent, it's to the level of, the sun coming up in the morning, okay? And that's kind of my message to you, is that if you're trying to figure this out, recognize that there are institutions that already got it figured out. And this was kind of my big aha moment years ago after trying everything under the sun myself. Some things would work for a period of time, then I'd go on a losing streak, and I'd feel, like I need to find something else and go on to the next thing. And it's just been it was always that cycle. And then I tuned into JP Morgan's Investor Day. And I always knew that these big institutions made money hand over fist, but I didn't know how consistent they actually were. And when I saw this data and this information, it kind of radically altered my my pursuits. They don't sell subscriptions to their trade ideas, but what I decided was, if these guys are so radically consistent, there's got to be a way to track and follow what they're doing. Clearly, they have a systematic, predictable process of doing something, because it's leading to systematic, predictable results. And that's what I set out to discover, was how can I follow these guys? Because everybody that's trying to sell me something seems to just be reinventing the wheel and saying it's an awesome widget that will solve all my problems. And I thought, these guys are already solving my problems. I just need to follow them. And so that's kind of my, I guess, my view of the market is that there's 2 people. One of them can control and move where things go, and the others don't. And I was not in that arena of being able to impact the market, and these guys were. And I made it my mission to figure out how to follow them. And I think that if you'll learn how to do that, a lot of your problems will go away. So that's what we're going to talk about here today. I will answer any questions that you have along the way. So let's go ahead and get started. Let me just first really quick introduce myself. My name is Nick Lovelace. This is me and my wife. We've got 6 kids. We currently live in Tampa, Florida, or it's been extremely cold. You know, we're from Utah, but it's been down into the 40s and 30s this week. But you know, this is my family. We love to do everything outdoors. I attended Brigham Young University after going on a church mission for a couple of years to the Philippines, and then I've you know, worked for a small hedge fund called the G Fund, and then ended up going out on my own and have created a hedge fund called Alphax Capital. We manage, you know, money for basically ultra wealthy individuals and institutions, so I currently sit on the board as well as the chief investment officer over there at Alphax Capital, and that's been a great experience. We also started a retail group called the Super Trader, where we were able to take the systems that we've been able to develop that give us consistency and predictable results, and share those with other self-directed investors who aren't ultra wealthy, who, you know, some of them are you know, out of work, or they're just retired and they don't have enough saved up, and they've got to kind of kick it in gear a notch. Some of them are, you know, in retirement, and they've got to supplement their income that they just lost. Some of them are really, you know, they lost a lot of money in 2008, 2009, or even 2020, and you know, they've taken things over, and I feel like, you know, if my broker can lose it for me, I'm going to take it over and figure this out. But we started that group to where we were able to pass along institutional grade systems that give predictable results to those that want to self-direct their own investments. All right, so let's hop in here. How do we get in and out of positions at the right time? Let's make sure that we are all on the same page. What we're talking about here is this, right? We've got a chart, and ultimately what you and I want to know, we want to know, when is it going to stop going down and start going up? And when is it going to stop going up and start going down? And we've used things like this, right? We've used trend lines, we've used channels, we've used patterns, we've used indicators, RSI, MACD, stochastics, DMI. There's all sorts of things that we utilize to try and determine how best to get an edge and get into things at the right time. So that's what we're talking about here, right? If we can fix that one problem, almost every problem that you have will disappear, including, I don't know how to trade Forex or currency or options or stocks or whatever. Your instruments, your derivatives, your securities are secondary to this one big problem. And really, if I could just, you know, give you some advice that is unsolicited and from a practical stranger at this point, it would be this. A lot of people are interested in selling you something, and you've got to recognize that. And no matter how attractive something is, including what I'm going to talk with you about here today, you got to recognize that you do have some issues in the market, and there are some that can help with those. But your primary issue is getting in and out of positions at the right time. And if you will make it your mission to fix that one problem, everything else will kind of take care of itself. So here's my view on getting in and out of positions at the right time. Like I said, there's two core groups of people in the market, non-professional and professional. The FINRA, which is our regulatory authority for our financial markets in the US, they say that non-professionals, those that are designated as non-professionals, those are individual traders. Their buying and selling has no major impact on the direction of individual stocks or in the market overall. Now that's a general statement, and for the most part, that's true. We've seen situations like an AMC last year where a group of retail traders, gathered together on the same mission can affect movement of a security for a certain extent, but not very long. I mean, if you look at this, it didn't appear like it here, or maybe even here, or maybe even here, that retail is no longer in control, but retail is no longer in control of AMC. These big dominant institutions are the ones that are in control. And you can drive yourself back crazy hanging out on forums and Reddit and trying to gather together with retail traders to move an underlying, or you can recognize that there is a force that moves the market, and your best path forward is simply aligning your decisions with them. You see, professional designation, otherwise referred to as institutional traders or smart money, these are pension funds, hedge funds, banks, insurance companies, other large investors. They account for the majority of the volume. And because of their dominance, their buying and selling is what leads to big price moves in individual stocks and the market overall. So that's principle number one: is you're a small fish in a very big ocean, and your best way to get along is to make friends with the shark and clean his teeth. Okay. My son just did a book report on this little fish that hangs out by the shark, and they've got a mutual agreement. And that's really, I think, what you've got to view as your best path forward. It's not subscribing to some talking heads trade ideas, or getting that training or this tool. It's following the people that move the market. Unfortunately, they don't sell a service that gets you access to their trade ideas. So that's the fastest way that you're going to achieve radical, consistent, predictable success, is by following these big institutions that move the market. So how do we do it? The way we do it is by indirect observation, kind of like the way that we look at a black hole. See, there's a lot of ways that you can attempt to directly follow them. There's websites, entire websites. One of them is fintel.io. We can come in here and let's just go see what Bridgewater Associates is doing. This is, again, the largest hedge fund, most profitable hedge fund in the entire world. They impact the market. And we can come in here and see what they have in their portfolio. Any hedge fund or institution that is larger than $100 million under management is required by the SEC to report their positions. And we're going to find here that, Bridgewater, their largest position is in emerging markets. Their second largest, their third largest is in emerging markets. So we could follow suit and make an assumption here that, here's the most profitable hedge fund in the world. I'm a small fish in a big ocean, and my best path forward is to just do what they're doing. And we may be correct in that assumption. However, notice here that they are only reporting about $18.3 billion of positions. This is a $160 billion fund. Where are all their other positions? Where is all the other capital? And are these positions that they're reporting, are these more of a hedge to some larger investing that isn't required to be reported? The other thing is that these reports are always delayed. This report was released in November of 2021 for the quarter ending September 30th, 2021. They could be long gone out of these positions and we don't know it. One of the other ways that we commonly will attempt to follow institutions is by looking at things like unusual options activity, or even you've heard talk of these dark pool orders, right? All of these things are hitting on the right idea, but will never allow you to really truly be aligned in a way that gives you consistent, predictable results. I mean, we can come over here and see that somebody bought put options literally just 1 minute ago on Twitter. They bought 2,500 contracts of put options on Twitter. And we could come over here and say, all right, well, they paid $1.87 per contract of these. Now, they spent around about $500,000 on put options in Twitter. That could be a large self-directed trader. It could be an institution. But you can come in here and see these things, these big positions that, you can go and make assumptions on them. Somebody here sold 3,500 contracts of call options in Tesla and bought 3,500 contracts of put options. For those who understand buying a put option, that will end up increasing in value if the equity drops. Selling a call option is going to benefit the seller of those call options the same way. If the stock drops, they're going to be keeping this credit. So this position right here is a very large position, a very, very large position. That position right there is going to require really close to 300 million in margin requirement. That's a big institution, and the way that it's structured, that is a bearish position. So we could take that assumption that there's a big institution, they're bearish on Tesla, maybe I should be bearish on Tesla. But when we do this, we make big assumptions, and we all know what assumptions do. They make a you-know-what out of you and I, right? We have to assume that whoever did this is getting into the position right now. They're opening it instead of closing an existing position. They may have been short puts and they're buying to close them back. They may have been long calls and they're buying to close those back. So direct observation, whether it's following unusual options activity or taking a peek into the 13F filings of some large investor and following them, it requires big assumptions that you and I can't take those leaps and succeed on a high level. So how do we do it? We do it in the same way that we observe a black hole. And I really like to observe, I like to think of these big institutions as the black holes of our stock market. They kind of eat up all the money. They take it all, and light gets sucked out of us, right? So it's kind of like this, right? If NASA says that the way that we're able to detect black holes, I mean, this is the largest, most powerful force in our known universe, is by watching for their effects on nearby stars and gases. And that's how we're going to proceed today. And that's what I want to teach you how to do is, number one, your best path forward on having consistent, predictable success, getting in and out of positions at the right time, is by following the forces that move the market. Institutional investors, large investors that control most of the volume, they're the ones that move things. I can't directly follow them, so we indirectly follow them, because just like a black hole, they leave an imprint on the overall up and down of the market, okay? There are three effects that they have. So it's kind of like a pebble or a rock. When you throw it into a pond, there's a ripple that is left behind. And there's no way that these large institutions can avoid leaving a ripple. Now, again, they do things like dark pool orders, where they may want to buy 2 million shares of something, and what they'll do is they will structure it such that those shares are leaked 1,000 at a time, all throughout the day and multiple days. and they can disguise their activity, but we can identify that as well and know that they're up to something and follow them and benefit. So here are the 3 ripples that you're looking for. The first ripple, and when I say ripple, I'm talking about our pond is the market. If there was no buying and no selling, we would have a flat line price. It wouldn't go anywhere. But because there's buying and selling, we have ripples. And institutions, these big institutions, they leave a particular ripple that allows us to know where they do their activity. The 3 primary ripples that we have in our markets are price clustering, chasming or gaps, or vertical imbalances. We've all seen this, where price goes up and then it kind of does this number and bounces around and then may gap down or gap up and continue vertical to go higher. Okay, this is all part of the auction of the market, the ebb and flow of the market. However, institutions do business in one of these profiles for the most part. And as I said, for the most part, occasionally they will transact business, that is, they'll buy and sell in 2 of these other ones, but there is one of these profiles that if you see it happening, you can assume institutions or the big forces that move the market are doing business. Which one of these 3 do you think that it is? A, B, or C? Price clustering, price chasming, or vertical imbalances, where there's a series of higher highs, higher lows. And again, this can be reversed. There's gaps lower and vertical imbalances lower. Now, as you think about it and as you answer, which one of these price profiles do you think institutions do most of their business? Let me just walk you through a couple of things. Recognize that the up and down of the market is simply a computer attempting to balance buyers and sellers. If you are an institution, go ahead and put in your answers. Appreciate it, Frank and Joseph, for going and putting in. Scott, you too. I'll reveal your answers here in a moment. As you think about this, pretend you're an institution and you've got $100 million that you need to deploy in investments. What you have to do is you've got a choice. Recognize that on any given day, let's say you want to pursue a position in, let's just call Nvidia, okay? I don't care what the ticker symbol is, but let's just call it Nvidia. And on any given day, let's just say that you've got $100 million that you've earmarked to be invested into Nvidia. If you come to the market at the open and you put in a limit order for $100 million worth of Nvidia at the market, what will happen is you are going to impact the auction. That is, there's not going to be enough sellers at the market price that we're at to satisfy your buy order. There may be 10 million worth of selling orders at the price that Nvidia opens up at. And so 10 million of your 100 million would get filled. And then what would happen, because you are such a large order, the auction or the computer program that attempts to balance buyers and sellers is going to go and search for sellers. And here's how it will happen. It will move price up really, really quickly. And it will fill another 10 million orders, 10 million shares there for you, another 20 million shares here, or 20 million worth, another 25 million here, and so on and so forth, until it has found enough sell orders to satisfy your buy order. And in order to accomplish that, it has had price go way up And then what will happen is once your big order gets filled, price will crash. This does happen on occasion. We call them flash crashes or fat finger trades. You've heard of these before. This is unorderly. This does not benefit an institution. Here they got filled all the way up here and then price crashed right back down because there's nobody as large as they are behind them to continue to bring prices higher. That is not how institutions would like to operate. Same thing, but the opposite. If you want to sell 100 million and there's not enough buyers and you try to sell all at one time, it's going to crash things and they'll come right back up. Okay, not good for you. You don't want to sell all the way at the low and then have it come right back up. This is unorderly. So institutions are orderly in their transactions typically. Okay, again, there's fat finger positions that go off, but typically there's one profile that indicates that institutions are transacting business, and that is A. So for those of you got A, great work. For those of you got something else, don't worry about it. This is really your best path forward, is learning on a deep level how the markets move, who moves them, and how you can get aligned with that. If you'll do that well, then a lot of your problems will entirely disappear. So, principle number one, you're a big fish in a large ocean. Your best path forward is making friends with or aligning yourself with the big sharks, these big black holes of the market, those massive forces that suck everything into themselves. The best way that we identify them is by recognizing the effects they have on the auction, the ebb and flow of price. And because of their sheer size, they just can't get all in and all out. Sometimes they do, but most of the time they don't. And so this is the profile that we're looking for. All right. So we've talked about a lot of things. We're going to piece it all together. So remember, JP Morgan, right? Remember their little slide deck there? These guys are radically consistent. Their results are absolutely predictable. They don't have big up and big down. I mean, it's just like an ATM for them. They just suck money out of the market. So if they do most of their business in these price clustering areas and their results are radically consistent and predictable, there must be some connection between clustering on my chart that I can identify, and I can start to predict levels where they're going to do business. And there is. And that's what we're going to go through. The rest of our workshop here today is showing you how to identify these things and then what to do about it. All right. So go ahead and let's get into some of this. Maybe if I can, I'd like to go through a couple of things here with you, but go ahead and put in the chat if there's an equity that you have that we can look at and identify where institutions do business. Go ahead and put that in the chat. Give me a ticker symbol, give me something here. And what I would like to do as we get those coming in, is I'd like to show you the power of doing this. What happens when you're able to do this? This is a principle that can be applied to all time frames. And what's so fun is that when you do that, you can really position yourself very well. Yesterday, we had we do a trade room where we do this intraday with our retail group. And we follow basically the smart money, okay? And this chart right now it's not going to make a lot of sense to you, but each of these levels, these black lines, are at equal distances between each other, and so are these purple lines. They outline intraday institutional levels. And what happens and what we're able to do with these is we're able to take positions because price will predictably move through these levels. For example, yesterday when we opened up right at one of these black levels, and we dropped down, and it continued down into this black level, and then it bounced back up, right back up into that black level, and then we continued down into that black level, and then we bounced up to this black level. And so what we're able to do, I have a very difficult time knowing how long something will go. You know, for example, we don't know if it will go up here, then back down here, then up here, then back down to this purple, and then all the way up to here. We don't know if it's going to, you know, come up to here and then up to this black and then back down to this black and then go all the way up to here. There are hundreds of ways that things can proceed. And so what we do on short time frames with this, and I'm going to show you how to identify these zones. But what we do is it's so predictable that we're able to leg, and we're going to be right very quickly. And so what we do is we'll come in, and in this instance, we bought put options at a certain price. And then because this methodology on the intraday time frame is so accurate, for a certain period of time, the market is going to drop and it's going to do what we think it will do. And as it does, what we'll do is we will sell a put option against that position, and we will create what we refer to as a risk-free spread trade, where we have zero risk. In this instance, this particular position is a risk-free bear put spread. If the market finishes below 43.05, I will end up making the difference between 43.05 and 43.15. I make $10 if we're below 43.05 by the time this position expires. If it does not end below 43.05, notice I brought in $72 of credit and I paid $62 in a debit. So I brought in $10 of credit. So what typically is a $10 risk, the distance between my spread, and normally this trade is done for a debit, because this process is so accurate, at least very, very short term, intraday, these ones don't work long, but they work very quickly and they work like at 99 percentile. I'm able to leg into one part of the position, and then as it goes in my favor, get into another options position and create a risk-free spread trade. I'm guaranteed no matter what happens, I make $10 of profit no matter what happens. If it ends up below 43.05, I'll keep the $10 of credit, plus I make the $10 difference between the spread. So I'll make $20. These are all real positions that we put on. Yesterday in our trade room, we've put on more today that are all, we do it live in front of the group using this exact framework. And again, I showed you this. So again, I've been doing this for a while, and I know there's a lot of crap out there. But take, for example, right before you and I got started, I got into 10 contracts of call options at this 43.40 strike, 43.40. My average cost for those is $46.74. I got into those because we were at one of these institutional zones. Now, these are intraday. They're very fast moving. So let me clean up some of this stuff here. So I got into those call options right here, knowing that there's a high probability that we're at least going to bounce 6 points off of that. A 6-point move is not much. Okay, a 6-point move is right there, even less than that. Okay, that's all I need to do what I'm describing to you. And by doing that, so I bought those call options. I don't know how high we're going to go, but what I can do by following institutional levels is I know I'm going to be right very quickly. Then I can sell a call option against it. And that's what I did. I sold these 43.35 calls. There's 10 of them there. Okay. And it literally got filled, I think 7 minutes after you and I started here today. Actually, no, I apologize. 5 minutes before 7 minutes before, or 7 minutes after you and I started at 12 p.m. Eastern time, I heard a ding go off that I got filled on these short calls right here for $52. So this is what's called a bear call spread. Again, I don't care if you know what options are. That's not what this training is about here today. But I'm showing you that I can use institutional levels where they transact business to give myself a ridiculous edge. So if I were to just get into a bear call spread, for those that understand these, essentially all I care is that the market stays below 43.35 by tomorrow. But what I've done here is I've legged into that position. If you just get into that bear call spread at once, it's going to give me a credit. I'm going to get paid a credit. In this case, I'll just lock this down. It's a $2.50 credit. So I'm getting paid $2.50 per contract. If I've got 10 contracts, that's $2,500. And as long as it stays below or finishes below 43.35 by tomorrow, I'll make $2,500. If it doesn't stay below 43.35 and we rise above that, I can lose up to $5. So my risk in this trade is $5 minus my credit. So I'm in it to make $2,500 and I'm risking $2,500. That is if I do this at one time. But because you can follow institutions and it works 99% of the time this way, you've got a really, really good edge. So what I did though was I bought the call options for $46.74. I sold the call options for $52. So I got $52 of credit on these short calls. So I've collected now $5.26 in credit. My risk in this trade is still $5 minus my credit of $5.26. So my risk in this is that I am guaranteed to make 26 cents no matter what happens. Now, I'm not in the position to make 26 cents. I would like to make $5.26. I will make that if we're below 435 by Friday. And this is one way that we can apply this methodology. And as you can see today, this is not a large account, but I've got these risk-free positions laddered or layered all throughout my options chain. There is not one position in this portfolio that has any risk whatsoever. I cannot lose one penny no matter what happens. And I am guaranteed, when you add it all up, I am guaranteed to make at least $10,000 by tomorrow, even if the market doesn't go in favor of my spread trades, because I'm using these institutional levels to leg into these positions. This is one way that you can use that methodology. There's a lot of other ways we can use it, but this is powerful stuff, folks. Okay? This is powerful stuff. If you can learn how to follow institutions, it changes everything for you. So I've got some requests here for positions or equities that we look at. So let's go through these. I don't know that you guys can see these, so I'll take a snapshot. We've got Tesla, FNF, AMD, gold, SPX, Nvidia, silver, Bitcoin, Palantir, QUBT, SI. I'm not sure if it's being recorded or not. It may be. I think that it is. I'll have to check with Anna. Halliburton, ERX, PM, SPY, Snap, Please, MOS, APRN. Okay, so we won't have time to go through all of these, but let's go through as many of them as we can. And really, because we don't have time to go through all of them, what I want you to get from this is the principles of how to follow these institutions. Forget about the ticker symbol. This is a principle that can be applied to everything. As long as there's a significant amount of institutional activity, these principles can be applied regardless of the equity. Okay, so tech is taking a big hit right now, right? So we've got car tech, EV tech right here, Tesla, Nvidia, and tech is going to impact SPY and the SPX in a big way. You've also got AMD. So maybe let's get a tech one, because where's it going? Where are these things going? All right, and so let's do Nvidia real quick and walk through how to identify these zones. Now, if we look at this, a lot of us look at this and say, boy, I wish I would have just bought back in 2015. That's always going to be the case, right? We have no idea of seeing what the future looks like in anything, and that's our disadvantage. We can't control things, and we don't know what it looks like ultimately. But by following this process, you're going to be able to participate regardless. So what I'd like to do is I'd like to go back to this area in 2015 and 2008, and I would like to show you that Nvidia, and I know Nvidia, it was traded by institutions all back here before its meteoric rise. It's trading at $220. It is still trading within the same predictable framework that it was trading when it was down here in the 1s and the 2s and the 5s and the 8s and the 9s. So I'm going to create this, we call it a matrix, an institutional zone matrix. I'm going to create my matrix, which are my levels that will tell me where institutions will buy or sell. I'm going to create that based on this data here. This is when the stock was trading down in the 9s. And what you're going to find is that a lot of us look at Nvidia and we do things like this. We'll come in and we'll draw a line like that. And we'll say, oh yeah, it's still on its trend line. Or we'll do something like that. Or we'll do something like this. And that's how we approach it. Okay? And that is not, I mean, ask yourself, do you think really? You think that is how JP Morgan is getting these results? Is that delivering them consistency? Is that predictable? No, it's not. Okay, this is random. When you draw these trend lines, it is randomly generated based on something that you think is plausible, and it requires multiple points before you can draw one. You couldn't have predicted the first point, and you couldn't predict the second point. What I'm going to show you is that things are radically predictable, and it's because institutions need it to be. So here's how we're going to do this. See all this clustering down here? Okay. Remember, if institutions of JP Morgan really is consistent on the level that they say they are, then, and they do most of their business in areas that doesn't cause price to go radically against them and then come right back down, then we're looking for these clustering pockets where, you know, it spends some time. This is a monthly chart, meaning each one of these candles is a month-long duration. That's a long period of time there where it's clustering, okay? And here we're also looking for these vertical rises, and then the areas where they just kind of stop and cluster for a little bit. Those are also going to be things that we're going to be able to connect. So I'm just going to start taking a stab at this, and this is how you go about it. I'm staying away from current price action to build this framework because it keeps your analysis honest. So I'm going to go ahead over here to that clustering that happened all the way back in 2003, And this is going to be my first auction zone area, okay, or institutional zone. Meaning this is where institutions, I'm saying that if it drops down to here, institutions, price is likely to stop going down, and at least for a period, it's going to honor this level. This is going to give you a framework to predict things before they happen. And what you're going to find is that this is more than just drawing lines and connecting points. So what I've done is we've got this kind of, 2.5 year clustering area. The boundary of that clustering, where it kind of just went up and down between it, is kind of right there. I'm interested in kind of the extreme area of that, where, yeah, it may stop right here when it comes down, but I'm interested in where's the extreme level there. And I've outlined that with this first set of black lines. We're going to call that our first institutional zone. Now what we're going to do is we're going to duplicate this line, because if institutions are having predictable results on the scale that JP Morgan relates, then this is not random, it is predictable, and they're interconnected. It is more mathematical. And so what I'm going to do is I'm going to duplicate that pair of lines. I'm just going to pull this up to where I can identify that, boy, it seems like, here's some other clustering areas. And it seems to me like, yeah, when price rises up to there, it's resisting on it. Okay, so here's what I get right here. Okay, it dropped back down right here. It clustered there. And then when it broke, what did it do? It went vertical and then came back down. And where did it stop? Right in my zones. And then we came down to that one. Where did it stop? Up here, right in my zones. Stopped in my zone there. Broke up above, came back down, right into my zone. So from now on, every one of my levels will have the exact same distance between them as these two do. If I've done this right, 95% of all of your tops and all of your bottoms will fall within this framework. Do you hear that? 95% of all of your tops and all of your bottoms will fall within this framework. Look at that, okay? So all I've done is I've gotten this little yellow rectangle, and I measured the top of that zone to the bottom of that zone. And then I pulled that rectangle, that measurement tool, I pulled that up, aligned the bottom right-hand corner of that rectangle with the bottom of this zone. And then I duplicated this zone and pulled up my next zone to the top left-hand corner of my measurement. And look at that peak. All right, good enough. But is it still relevant today? Is it still relevant today? So Trader says, is this for a subscription? No, you can do this on your own. I'm teaching you the fundamentals of how the market operates, and encouraging you, you need to get aligned with this, because this is the force that moves the market. And if you'll get aligned with this, it will change everything for you. Everything. I mean, I talk to people who would just be happy with making $250 a day extra. I mean, you're so far below what you're capable of accomplishing in our financial markets, because everything you do is typically against institutions. And by doing this, it will change everything for you. So here's what I'm going to do. Price is way up there. So let me just quickly go through this. So we're just going to build out this matrix, and it looks as though, we can't see yet if things are honoring our levels, but take a look at this. All right. So again, we didn't see any of this. All right. But what happened here? Here we broke. And where did it stop? Right at our zones. Where did it stop going down? Right at our zones. See, again, I told you, it's difficult to say, is it gonna stop at this zone? Is it going to stop going down at this zone? You and I don't know. And you need to recognize that's not your job. Your job is to assume that as we rise into a zone, that it's going to resist, that it's going to cluster, that price is going to stall. That doesn't mean it's going back down to 10, but it does mean that it's not a great idea to initiate a bullish position here until we break out of there. And if you're going to do a bearish position, that would be fine. But it's not saying that it's going to go past this one and then go up to that one and then go up. We don't know that. And that's not your job. So you're going to still have ones that don't work, but you're going to know exactly when they're wrong. And this framework will give you, if you'll keep on following it, it will be exactly where price stops going down. And it will be exactly where price stops going up. And if you'll follow this and have the discipline to get out of positions when levels don't hold, this framework will give you every level where your big reversals do happen. So let's keep building this up and see where this takes us. Okay, again, this is one that, there's a lot of price movement here along the way, but take a look at this here in 2018, 2019. I mean, I don't see up here where it stopped, but look at where it stopped going down, right at my zones. Look at that monthly candle right there, right in my zones. Look at where it rose to, and then it stalled here for a month and a half, 2 months before continuing on to another level, right at my zone. You're going to see this, and it will, I'm telling you, it will blow you away. Now, the distance between these zones, now with where the price is at right now, is going to be too noisy. But look at this. Here we rose up, rose up, rose up. Where did it stop? Right in my zones. Where did it come back down to on that month? Right to my zone. You see that? Everybody with me? Do you guys see that? Are you seeing how most of the stopping points for resistance and support are precisely in this framework that I created at a time that looked like it had nothing to do with current price? But because institutions don't have some human being watching moving averages crossing, or they're drawing fibs, or they're drawing, whatever it is, they're using RS, they're not doing that. This is mathematical. Because of that, and because institutions have been involved in this for a long time, what was the framework way back in 03 through 2012 is still the framework. Look at where we stopped right here. Look at where the pandemic low, when everything got locked down, look at where we stopped going down. Okay, look at where we stopped going down. Somebody asked me one more time, how do you create these zones? So institutions, they do business in areas where price clusters. I started by simply connecting some clusters with a set of parallel lines, and then duplicating those parallel lines and seeing if those don't line up with other clusters on the chart. And I identified, 2 levels and measured the distance between them, and have a good sense that this is kind of how things are going. All right, so here's what I'm going to do. I'm going to build out a couple more of these at this kind of really tight framework where there's not a lot of distance between them. But I'm going to, because the price is where it's at, we're going to have less of these zones. And I'm going to do that based on the distance between kind of where things are peaking out now and where they trough at. So here's what I will do. I'm going to now skip. So instead of having this distance between each zone, because there's just so many zones now, I'm going to go ahead and skip this one, this one, this one, and then I'll have that one. So let's measure the distance here between these this top zone here down to this zone here, and that's what I'm going to have as my new distance. That may not be it, but I think that it will be. So let's just do that. It's still following the same curvature, same distance. I'm just not putting in every single one of them. And let's see if this is following, and we'll build this one all the way up and see if this is what's working. Again, if you do this right, 95% and even higher of all of your zone, all of your tops and bottoms will fall within this framework, 99% of them. So let's go ahead and do this. All right, so we're almost there. That would take us another little while if we did every one of these levels. And just for sake of time, I am skipping a couple of the levels, and we'll see if I skipped it the right thing. All right. Hoo-wee. It is easy to forget how high this thing is, and we're a long ways up here. But I'm glad we picked this one first, just to kind of demonstrate. I mean, you saw in 2018, 2019, how it's following that. That's where your tops and bottoms are, right? In our institutional zones framework. All right, so here we go. We've got just a couple of more here, and we will have completed this. Oh my goodness gracious. That is way up there. All right, so here we go. All right, so now notice here that as we rose, this is the zone that we stopped in on the way up, right in our zone. Look at where we stopped at here on that month, right in our zone. We dropped, we came back down. Where did we drop to? Right in this zone. Where did we rise up to? We're going to continue to see that all of our tops and all of our bottoms are happening in this framework that we identified back when the internet was still kind of coming on. It wasn't coming on in 03, but it had been on. But this is algorithmic, folks. These institutions are not changing their behavior. It is not random. And you're going to find, I'll bet you, Nvidia was precisely in this framework at that high. And this time it decided, yeah, I'm going to come off to multiple levels down below. If you know that you are in one of these zones, you're rising into it, it allows you to position yourself accurately. Again, you don't know if it's going to keep going. You don't have control over that. But what you do have control over is to allow your zones to tell you what to do. And then if things get broken, you just get out of your positions. Look at that. So as we zoom out, it would have taken me 2 days to build out every single one of these levels. But as we zoom out, you're going to find that all of our tops and all of our bottoms are happening within this framework. If we come down here to a 1-year chart, okay, and take a look at this. Look at where that high was back here in November. I mean, I created this based on some clustering connections that I made between 03 and 08. And consistently, it is still working to where this is where we are stopping. This is where we're stopping. This is where we stop going lower and bounce back up higher. It is within this framework. That's where we stop going lower and bounce back up higher. Okay, here you chasmed around that one and kept going. Stopped right there and came back down to that zone. Stopped at that zone for a couple of days and then continued to that one. This is predictable. Now, knowing how to capitalize on this is different. And that's where you and I are always going to struggle. And that's why I like to use these risk-free spreads, because I know that as we come into zones like yesterday, it's going to work at least temporarily. I know that at least temporarily, I'm going to get a little bit of a bounce or rejection, and I can take advantage of that. Okay. So Frank, I don't know if that's a good thing or a bad thing. He says, makes me want to use daddy's driving words. Is that a good thing or a bad thing? All right, let me show you one more, but let's not go through, 20 years. I wanted to do that because, again, this peak right here is related to how it is algorithmically traded by institutions going back over 25 years. You can't not see that. Does everybody see that? Frank, hopefully that's that's an exciting way to use daddy's driving words and not I don't get it. If you don't get it, that's okay. We're going to keep going through it. But hopefully at least you can see, most of your rotations are happening precisely within this framework that was built 25 years ago. All right, let's go through another one. All right, let's go through another one here. Let's go, in fact, I want to show you the SPY, okay? I want to show you the SPY. Okay, I'm going to get out all of this stuff, and let me take you to our 20-year chart. Okay, these are the auction zones in the SPY. And so your primary zones are these black levels. The distance between each black level is the exact same, okay? And then this middle level is what we call a mid zone, and the distance between those are the exact same. Take a look at this. 2008, right at our mid zone. Where did it drop down to initially? Right down to our primary auction zone, and it spent 1, 2, 3, 4, 5 months, 6 months before we dropped down to our mid, and it bounced off of that, and then it dropped down below that one. And then it dropped down below this zone and down below that one. That one held for a month, and then ultimately down to this one, wherein it clustered in that area and rose up, clustered here, hit our zone, back down to our zone, hit our zone, back down, zone, zone, clustered, went up to here, spent 5 months in there, went up above, came back down, clustered here, back down to our zone, 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 zone. Okay, rose, 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 zone, zone. Zone, that was a little bit above, went down the mid, bounced back up to your zone, zone, mid. Okay, every single top and every single bottom will fall within this framework. It will fall within this framework. John says, if you do the SPY auction matrix, will it work for SPX and ES? Yes. Yes, it will. And that is what we're using for, we have intraday. This is a monthly zone. This is a 20-year monthly zone. This is your long-term stuff. This works, however, and there are different zones for all time frames. For all time frames. So somebody says something here that is really good. They said it's nice to see a chart to see how a stock has moved and see how they went up and then went down, but at any one point in real time, can you accurately predict what will happen next? So you either know to get in or know to get out. Yes, you can. And that's what's so neat about this, is that you don't take the position of saying this one will hold. It's saying this one, as long as we're below, should hold. Therefore, this is the position I should put on as long as we're above it. For example, right here, we came up to this mid zone. I don't know if it's going to continue to hold. But we went vertical into it, and we get some clustering. We've got certain rules that we follow where we need to see at least 2 days of clustering before initiating a position. But I can get into a bearish position here, stay in that bearish position until price shows me that this level is not going to hold as resistance. Same thing here, drops down. I'm getting into a bullish position as I drop down into zones. Remember, institutions buy into weakness and sell into strength. And that's how you need to be operating. So if you're dropping into a zone, get bullish. And this time it worked. Here we drop down below and we close below our zone. We're getting out of bullish positions. And if you want to flip and get into an alternate bearish position, at least down to that zone, you can do it. Your job is not to determine if a level is going to hold. You don't have that control. Remember, 70% of all the volume comes from institutions. You don't move the market. So there's not a way that I know of to be able to come in and say definitively 100% of the time it will always hold that level. But I can tell you close to 100% of the time, every single rotation that you have in the market will happen in these zones. Does the current drop stop dropping here? Or does it stop dropping here? That's not your job. Your job is to, as you come down into zones, put on the right position that assumes it holding, and if it breaks below those, get out, keep your losses at a minimum, and then do the next right thing at another zone. Every one of your tops and your bottoms will be within one of these zones. So no, active trader who asked that, I don't know your name. Again, I don't know that you guys can see this chat log, so I'll take a screenshot of it. The active trader, at any one point in real time, can you accurately predict what will happen next? So you either know to get in or know to get out? That's not your job. I can't move the market. You can't either. But if we know where the rotations are going to happen, that is all the edge that you need. Now, the reason why I like to get into risk-free positions, because typically I'm going to be right, even if it's just momentarily. Even if it's just momentarily. Meaning that, right here at that mid zone right there, if I take you into an intraday chart, on the daily time frame, it doesn't look like we responded to that level at all. Okay, doesn't look like we responded to that level at all. It's this purple line. Okay, again, here's your daily chart. This was last Friday. It doesn't look like you responded to that level at all based on this daily candle. But I found that zones don't just get ignored. They don't just get ignored. Okay, and if you take a look at Friday, it came down into that mid zone. This is a 20-year time frame, folks, that matrix in the SPY, this matrix in the SPY was created. It did honor that level temporarily, came down, clustered, and then broke and continued lower into our auction zone down here. Look at how the behavior was of price yesterday at that auction zone, this black area. Now, you and I on a daily time frame don't pick that up. All we see is, boy, we got a big tail, and yeah, it's right in my auction zone. And I got a tail down there today too. Look at how it interacted with it yesterday. Okay, Here we drop down to our zone, and that's where we respond higher. Here we drop down again. It resists inside, rapidly continues down to the bottom of my zone. That's where price supports, resists at the top of my zone temporarily, and then breaks out and comes back into my zone and holds. So if I know that it is generally going to respect my zones even temporarily, that's why I use a strategy that allows me to leg into a position where all risk is removed, because I don't know if it's going to keep dropping when it comes into here. All I know is that I should at least get a 6-point move in the S&P. A 6-point move in the S&P is a 60-cent move in the SPY. And so what we wait for as we come into zones, we wait for, on an intraday time frame, at least a higher low candle following the vertical drop into your zone. Once we have that, we can get in, and all I'm looking for is about that big of a move higher, and I can structure a risk-free spread trade where now I don't care. Maybe I'm buying call options here. Okay, you could buy stock. You could get into a bull put. There's so many different ways you can do it. I've found that by using options dynamically, I am right almost 99% of the time, where I get at least that small movement higher and then can create a risk-free spread trade that gives me further opportunity if it keeps going. And if it drops, I'm not going to lose anything. And that's exactly where you're seeing here, every position here is a risk-free option spread. Okay, this one right here, that's 4 contracts. I've sold the 43.25 call. I've bought in the 43.30. That's a bear call spread. Notice I brought in $66.80 of credit, and I paid $53.80 of credit. Or I'm sorry, debit. So if I get paid $66.80 and I had a debit of $53.80, I got paid $13 on a $5 wide bear call spread. Again, if you don't understand these things, don't worry about it. We can help you understand these things. What's important is recognizing that when you learn how the market operates, then you can use securities that allow you to navigate well, giving you a great edge. So if I've brought in $13 of credit and I've only got $5 of risk in the spread, take away that $5 from my credit, I am guaranteed, no matter what happens, even if we don't finish below 43.25 tomorrow, I will make $8 per contract. $8 per contract on 4 contracts. There's nothing that could happen tomorrow. We could go up 1,000 points. We could drop 1,000 points. I will walk away with $3,200 in profits. As long as if it finishes below 43.25, I will make the full $13. I will make the full $13 times 4 contracts, $5,200. So in this case, I bought the 43.30 call options first. Those are a loss right now. Those are a loss. I don't use my positions in a way that is not helping my edge. I use positions in a way that says, I know these levels will get honored at least temporarily. I can use securities, in this case options, in a way that position myself for substantial return and remove all risk. Does that make sense? So no, active trader, I don't know if this zone is ultimately going to hold beyond today, and then we're going to be at this one tomorrow. But I know that there's a certain time frame where my things work and I can put on positions. Even if you just get into a bull put spread right here, it worked temporarily. Or if you buy the equity, you know when it doesn't work, you get out. Because I can tell you, whatever the bottom is going to be, if this is it, okay, it will be, the bottom will be in one of your zones. I don't know if it's this one or this one down below or two down below it. So you get involved, and then if it's not holding, you get out. You keep your losses minimal. Maybe it rises only up to here. I'm going to know that, and I'm going to be on edge to see. I'm going to protect my position, get out. Typically, I'll wait to get back in once it breaks back above, and then I'll ride it to the next zone. The market is predictable, folks. It is predictable. And this is how the fundamental forces of the market work. So there's a lot here. We could go on and on and on about all of this, but hopefully you've been able to see that things are predictable. I would love to do it with SI. We're all out of time, but this principle is going to be able to be applied across numerous things on almost anything that an institution would get involved in. So let's do SI just because, you know, my friend had the courage to ask for it again. Okay, so this will be my first set of zones. Okay, and let's duplicate that. Let's pull that down. Again, this one's hard because I'm close to current price action, and so it's difficult to sometimes be totally honest in your analysis. But let's just go ahead and do this real quick. Okay, and let's see what we get. All right, so boy, that lines up perfectly with the bottoms here. And then let's go and see, is that what we were into on the top? Okay, so here we've got this, and look at that, right up in our zone right there. Now again, you know, just because it's never looked above that top zone and below this bottom zone doesn't mean that it's not going to. But what are you doing right now? You're getting bullish at this level. Is it going to hold? I don't care what your outlook is on the economy. You need to set that aside. I don't care if Obama's the president or Trump or his daughter's, sister's, baby's mama. Your political views and your views of the economy, you line 10 economists up and they're going to disagree a lot of times. This allows you to follow a framework that guides you precisely. You get bullish here. If it breaks that, it's probably going down into that next zone down here. You're going to get bullish again down there. If you want to get bearish all the way down to there, fine. I don't care. Here, it broke down below, came back up to, resisted, failed. That's what I wait for to get bearish, is you break a zone, come back up to it, and then follow it up with a lower low, lower high on that day. You're getting bearish there, and you can write it down to your next zone pretty well. This framework will guide you. It doesn't mean that I know that this is going to be the zone that it holds in, but I can tell you every single one of your tops and your bottoms are going to fall within a very predictable framework, because institutions make all of the money. Your fastest, most reliable way for you to skyrocket your accuracy and your success is by following them, and you can do it with a small account. This is an account that is under $100,000. But by using options strategically with these zones, I've got a $22,000 profit in a day and a half on these positions that I've put on between yesterday and today, using this framework, and I have no risk in doing it. So hopefully this has been enlightening. Okay, hopefully it has been enlightening. We could spend all day going through how's the width of the zones, how are those determined, and look. Okay, you know, our team, I don't claim at all to be the whiz kid behind all of this. You know, we've spent a significant amount of money developing this framework. There's a deep amount of mathematical substance that backs it, and we did that for our institutional clients. They require us to be consistently profitable, and that's something that for those that are self-directed, we've shared that with them, and we show them how to do that. And so, it's so fun. You can be somebody like Joseph, where you're just an average person, and if you don't think that you can do these kinds of numbers, it's because you have not been participating with the force that moves the market. You're working against it. And that's what we can do. Here's a regular guy who is not a millionaire, who's got $100,000 or so to his name. It took him 18 months for us to get his account up to where it could do these kinds of numbers, but he's having $100,000 months following this framework. You can see why, if you've never had success before, this will work for you. This is not some concept or some idea from somebody. This is not Nick. This is, man, Nick, I'm tired of Nick being in the way. He just loses money. Who's making all the money? Institutions. I'm on a mission to learn how to follow them, and that's what I've made my mission, is how to follow institutional investors well. And so how can we help? So what we've done in connection with this workshop with Investors Expo is we've set aside some time over the next 48 hours, where if you want to talk about these things and dive into them more on how you can apply them, whatever your biggest challenges have been, our team has seen it. We've overcome it. We've built systems to deal with it. Every single issue. So what we'll do is, if you want to sit down and have a chat, we've got some time open where we can do that with you. On this session, what we'll do is we'll work with you to craft a step-by-step game plan to hit your income goals for the year, whether that's $10,000 a month or $10,000 a year or $200,000 a month, and how to become a master at getting in and out of positions at the right time by getting aligned right. Stop following the talking heads and your concepts and ideas and the trade recommendations, and start getting aligned with the forces that move the market. So if you want to do that, we've got 5 slots set aside where we will hop on the phone with you and dive deeper into this to see if it's something that you want to go down and get involved in. The cost of this session is nothing, but there are some prerequisites. You have had to have already gone through some stock market related training, understanding, really the fundamentals. If you're still trying to figure out what's a stock, you've got some things that you need to learn before you even need to start dealing with, figuring out how to follow the forces that move the market. But if you've done that and you've got a good handle on kind of the fundamentals and are still struggling to find consistency, that's who this call is for. The other thing that I'm going to say is, if you book one of these times, please show up. We've set aside only a certain number of them, and if you take one from somebody else and you don't show up, that you're really, you got to take this seriously. The real people out there are having real problems, and if you are having those, we want to talk to you, and I think we can help. But show up for that call and have some respect for us, because this will change everything, and honor those that just didn't get a slot. So if that's you, book a session now. So I don't know how to put this in there. I think I did, but here is the thing. So why are we doing this? If you're skeptical, you should be, okay? We do this because, number one, we love giving back. This is an industry that has a lot of people that don't give things that really work. And part of our mission is to not just help, ultra wealthy, institutional, accredited investors, make money like we do over our hedge fund, but part of our mission is to really make a difference for people at all levels. And that's what the Super Trader group and community is for, it's our way of putting into the hands of self-directed individuals, no matter their level, whether they're kind of just got a little bit or they've accumulated decent wealth, giving you a framework that will allow you to build wealth predictably, consistently in any market. Plus, we know that you may want our help to transform your trading, and if you do, we can discuss that and see if it's a good fit for both of us. If not, that's fine as well. So there's a lot of comments in here, but I would encourage you, I'll stick around and answer any questions. Like I said, we've got 5 slots set aside. I think we'll have Porter, we've got you in. But we'll see how that goes. We'll give it the next 5 minutes. I'll answer some questions, and if there's a ton that don't, then we'll open a couple more. So, okay, what questions do you have for me, folks? How do you know which stocks are institutional targets? Okay, so this is a really good question. You can use something like a Yahoo Finance to kind of curate a list. We've curated a list that I'm happy to send you, but really look at the S&P ETFs and the top 10 holdings in each one of the S&P ETFs. So the basic materials ETF, look at the top 10 holdings. The communication services ETF, look at the top 10 holdings. Look at energy, the S&P energy ETF, look at the top 10 holdings. Every single one of these is going to have a significant amount of institutional participation and will follow this framework. Okay. Yeah, Trader says, please include me in your 5 sessions. You got to go book that, my friend. You got to go book that right now. So the way that you do that is you go to thesupertrader.com/chat. Okay. It does work in futures. It does work in crypto. As long as they have a large amount of institutional volume. You're going to remember, institutions aren't sitting behind a screen, looking at moving averages or RSIs crossing. They are using algorithms, and this is, for the most part, the framework that they follow. It's really neat. So yeah, Trader, you got to go and book that session, sir. If you want it, you're going to have to do it. So. All right, so I've got Adriano, we've got you in. All right, what other questions can I answer? There is certainly a lot here. I sure hope there will be a replay. As a total newbie, I'm unable to keep up. Love to review all this so I can attempt to understand what all this means. One very small piece of info at a time. Need some indication within myself first that I can actually learn this. Anybody can learn this. I empathize with you. I know where you're at, and there is a lot here. Okay, so Trader says I'm unable to log in. Yeah, so I think what you're talking about there, Fred, you filled out our enrollment thing. Yeah, we're not an open enrollment organization, so you can't go in and just buy what we do. Really, we only work with those that we know for a fact that we can help. So this consult is really to break down what you've got going on, what your goals are, what your objectives are, what your current level of understanding is, and then we'll help you craft a plan on steps you need to take to get to where you want to be. If that means you want to look at working with us, we'll talk about that. But no, there's nothing to buy here right now. Does this work for small accounts? Absolutely it does. One thing that we do every year with our group is we'll have what's called a marathon week, where we'll start with a really small account, and essentially we will follow these zones intraday and see how far and how fast we can get it. Our last couple of times it would be It'd blow you away. Again, everything that we do, I'm not one to just throw out numbers. Somebody typed in CHATT. You're probably at the wrong page. Make sure you're going to CHAT, so /chat. So I'll put the thing there. Somebody said, what's the monthly or annual cost? So it used to be that we would work with every one of our clients over at the Super Trader one-on-one. But we've really built out an environment where, the group is in here. We've got training that you can go through on demand. Again, I'm not here to pitch any of this to you. So, but back in the day when we were all one-on-one, and you still have one-on-one support from myself, you can just schedule that one-on-one anytime you need. But because there's a lot more things there that you can go through on your own and learn and apply that process. If we were to partner with somebody, back then we charged about $16,500 to contract with somebody. But again, it's for life. We don't, if you lose money with us, we give everything back. We charge a lot less than that now, like a fourth of that, not even. Because it's just more streamlined and doesn't require us to get away from the have to be there with you every day. But it's that again is not something that again, if somebody loses money with us, we give it all back anyways. And so if we were to get to that point where we were talking about that, then that's what you could look at. Okay, so we've got Sean and we've got John, Marjan, Donald. All right, I'm going to open up 3 more here and we'll be good to go. Fred, we've got you. Caesar, I've got you in. Ben, I've got you in. Okay, does this work for small accounts? Yes, so let me pull this up here and I'll show you. So one of our recent marathons that we did, let me just pull it up. I'll pull up the screen grabs of our actual positions. So can you get me? You're gonna have to schedule, I don't know what your name is, whoever said that. You gotta go and book that time there at that URL that I just gave you. So make sure if you're wanting to do that, make sure to book it. Okay, so we took, this was a $2,000 account. And in 5 days, we took it up to about 27,000, almost 28,000 using this exact same process. Again, look at this, okay? I'm selling that put. I sold it for 79.5 cents, and I'm buying that put option for, I'm sorry, I sold the puts for 92 cents. That was my trade price. I bought the puts for 87 cents. So again, here is a risk-free position. And that's how I like to use these zones, because you just never know how long they're going to hold, but they always hold at least temporarily. I'm guaranteed to make 4 cents. This is a position in the SPY, but I like these risk-free positions. They give me a really nice edge. So that was one of our marathon weeks. And then we had another one here where we took 2,000 up to about 79,000, I think is what it was. I'm trying to find the screenshots of that. So yes, it does. It works with a small account. Okay, so Mohammed, did you book that call? You got to go to that URL, sir. You got to go to that URL to book that call. So make sure you go to that URL that's on your screen right now. Type it into your browser, www.thesupertrader.com/chat. If you have a hard time doing that for whatever reason, all you need to do is go to thesupertrader.com and you can, I think there's a way you can schedule a chat with us directly from here. So if you go here, yeah, that's where it'll say, you know, it's not open enrollment. I guess there's not. But so yeah, you do need to go /chat. /chat. So make sure you go do that and book that. So he's saying that he's trying. All right, so what you'll need to do then is send me an email. And once we're done here, and we'll get that arranged. Send me an email though. I just put it in the chat, so write it down. It's NIC, NICK. All right, you guys. Boy, it's been a pleasure to spend some time with you. Hopefully this has been enlightening. I can tell you that it is, I don't know of a better way to proceed. Oh, I found that thing. Okay, so yeah, it was last year we put $2,000 of our stimulus check in, and we grew it in 5 days during our marathon week where we do this all day, every day with that group. We grew it up to 69,000. So here's the screen grabs of that. Day 3, we were up to 26,000 total. Day 4 is the only one I didn't grab a screen grab, but day 5, you know, we had day 21,962 day, and by the end of the week, we had taken the 2,000 up to around 69,000 using just, you know, that predictable framework and getting into risk-free positions. It's fun stuff. Once you know the channels, somebody says, do you know them? Are those the ones forever? Yes, they are. Unless institutions start changing their formula, which they haven't done since 2003, those are the levels. It's really quite a neat thing. Reyes is legendary. It really is so cool. Again, this isn't about me. There's a force that moves the market, and you can follow that force. We're really good at doing that, and hopefully you've been able to see that. You can do this, and hopefully this narrows down where you focus your attention. Folks, it's been a pleasure to spend time with you here today. Hopefully, I don't know if there is a recording. I think there may be, but Anna at Investor Expos would be sending that out if there is. Again, go to thesupertrader.com /chat and go ahead and schedule that consult with us, and let's have a chat about how to really get this cranking for you. Yeah, absolutely, Porter. Looking forward to talking with you. Trader says, I am able to enroll. Yeah, so again, we're not an open enrollment institution. We work with only those that we know we're going to get them to the goals they've got set. So on this consult, we'll talk about your goals. We'll talk about where you're at, where you're hoping to achieve, and if our, you know, how we work with people, if that is something that we know it will work well in line with your goals and we'll get you there, then yeah, we can talk about that and what that looks like. But we are careful with who we bring on, because when we bring them on, we work with them one-on-one, and if they lose money within 6, we give them all of their stuff, but we've never had to do that, and so we're very cautious with who we bring on. But definitely schedule that consult, and we'll talk with you then. All right, guys, have a great rest of your afternoon, and we'll see you next time.